keeping $30,000 in cash for 6 months quietly costs you $1,000. Not from a scam, not from a bad investment, from keeping money where it earns nothing. Here's exactly how it happens. Keeping cash outside the bank feels like the smart move. See it, touch it, nobody can freeze it. No fees, no middleman, no waiting. After 2008, after SVB, that instinct makes sense. But the feeling of control and the reality of control are not the same thing. Doing nothing with money is still a financial decision. That gap, 6 months, $30,000, has a specific dollar amount attached to it. Let's build it out. $30,000. Day 1. Sitting in your house. Nothing happens to it, right? Except that's not true. Cash doesn't sit still. It quietly changes value. Money sitting still isn't neutral. It moves backwards. Every dollar in cash has something working against it. No headlines, no alerts, just a quiet drain every single month. Inflation. The most recent CPI reading, March 2026, puts annual inflation at 3.3%. That's $82 a month in lost purchasing power. The cash in the safe is still $30,000. 6 months from now, it buys $29,505 worth of goods. You didn't spend $1. You lost $495 just by waiting. Cash has a cost, even when it looks safe. That's layer 1. Layer 2 is bigger. While your cash sat still, money in the right accounts was moving. Opportunity cost, the value of what you didn't choose. Right now, May 2026, top-tier high-yield savings accounts are paying 4.0 to 4.1% annually. Rates are lower than 2023 and 2024. The Fed cut 3 times in 2025. Deposit rates followed. Still paying real money. $30,000 in a high-yield savings account for 6 months? Roughly $615. FDIC insured, no market exposure. In your house? 0. Treasury bills. Same story. As of early May 2026, 4-week T-bills yield around 3.6 to 3.7%. $30,000 in T-bills for 6 months, roughly $548, backed by the U.S. government. In your house, 0. One note, T-bill interest is exempt from state and local taxes, not federal. HYSA interest is taxed as ordinary income. After-tax return depends on your bracket. Now add it up. Inflation erosion, $495. Missed earnings, $548 to $615 before tax. Combined gap, $1,000 to $1,100 on money that never moved. You didn't lose $1,000. You chose not to have it. That's the earning side. There's a third layer, nothing to do with interest rates. The average home burglary in the U.S. results in a loss of $2,661. Most people assume insurance covers it. It doesn't. Standard policies cap cash coverage at $200 to $500. You lose $30,000, you get back $200. Fire? No recovery mechanism exists for burned cash. Gone. The bank is different. FDIC insurance covers up to $250,000 per depositor per bank. Since 1933, not one insured depositor has lost $1. Your $30,000 is fully covered. At home, nothing. So why do so many people still do it? The illusion of control. The tendency to feel secure because you have physical involvement, even when that involvement changes nothing. Touching your money feels like protecting it. It isn't. Behavioral finance shows something else. Easier access to money means more spending, not less. $30,000 in a drawer doesn't protect you from yourself. It makes the money more vulnerable. The safest money is money that takes effort to reach. Some people hold cash outside the bank for real reasons: preparedness, privacy, distrust of institutions. But knowing the cost of that choice is what separates a decision from a leak. Full picture: $30,000. Outside the bank, 6 months. What you kept: full access, no bank involvement, physical possession. What it cost: purchasing power lost, around $495. Missed savings earnings, around $615 before tax. Missed T-bill earnings, around $548 before tax. Theft recovery gap, potentially $29,800 uncovered. Fire or disaster, full $30,000, no recovery. Total measurable gap, $1,000 to $1,100 before taxes, before risk. Not because something went wrong, because of how money behaves when it sits still. The financial system was built on one assumption: money should be working. Deposit it, banks lend it, you earn interest. That's the deal. Step outside it, you keep control. You hand back the compensation. The cost changes with rates. Near zero in 2020 and 2021, barely anything missed. Near 5% in 2023 and 2024, the highest cost in decades. Down in 2026, but the gap is still real. Same decision, different cost. Depends on when you make it. Keeping $30,000 outside the bank isn't a mistake. It's a trade. FDIC protection for physical possession. Interest income for instant access. Institutional risk for personal risk. None of that is automatically wrong. The question was never whether to make the trade. Did you know what you were trading? Most people don't regret the decision. They regret making it blind. $30,000 outside the bank, 6 months. Purchasing power down $495. Missed $548 to $615 in historically safe accounts. Risk your insurance was never built to cover. Now you have the numbers. The most expensive part of this story isn't inflation. It isn't missed interest. It isn't even the theft risk. It's making a $1,000 decision without knowing it was a decision at all. Doing nothing with money is still a financial decision. Cash feels still. It isn't. If this kind of breakdown, real numbers, no hype, is useful to you, subscribe. One financial idea, broken down clearly, so you can actually think with it. I'll see you in the next one.